Great, let's get started. Good afternoon, everyone. It is 12 noon here on the West Coast. Thank you all for joining me. This is great. I have some great information to share with you about the recession and what you can do to invest during this recession. I'm going to go ahead and share my screen now. My name is Eric Arndt. Those of you that don't know me, I am your family wealth advisor. I might be managing your 401k, I might be managing your individual assets, or you're here for a first time. Today, we're going to talk about the recession and how to invest during a recession. Okay, so today's agenda is I want to talk briefly about where we've been, just to kind of get everybody up to speed, where we are now, and where we think we're going. Now, as a recap, seems like a long time ago, but 2020 was a year of COVID. That was the pandemic. During that year, the US Treasury printed lots and lots of money, trillions of dollars. During that time, with all of this stimulus, assets inflated. That's housing, stocks, cars, you name it, they all went up. That was followed by 2021. That was the statement from the now Fed chairman telling us inflation is transitory. Then our president told us there is no inflation. Well, we all knew differently, and yet we still printed more and more money, trillions into the system, and we saw the highest inflation in 40 years. Everything went up. Eggs, gas, steak, bacon, right? Everything went crazy. So where are we now? They're calling this now the Purposed Recession. And the reason it's named that is because this recession is being brought on not naturally through the economic cycle, but on purpose through the Fed to slow down the economy. They've decided the economy is moving and it's overheated, moving too quickly. Inflation is rampant, so they want to fight inflation with historic rate hikes. That's one of the most important tools that our Fed has, is the ability to raise interest rates, and that will slow down the economy. That slows down corporate America, which then has to lay people off, which will lower demand for goods, which should lower prices, and then that's how they're going to get their arms around inflation. So far, year to date, it has not been a good story. The stock market has taken a beating. The bond market has taken a beating. As you can see on the right, everything is red. Everything is red. This has been very difficult if you're an investor. The economy has already started to slow. Because of that, layoffs have begun. Companies are now reporting weaker earnings, not terrible earnings, just keep that in mind, but weaker than they have been in quite some time. The big question right now is the Fed doing too much? And if they hike rates too high, can they crush the economy? And that could put us into a depression. And some would argue that the economy is already fixing itself, but the Fed is still focused on raising rates even higher. And so this, in this town square, we are debating what we should do moving forward. But for right now, that's what the Fed is going to be doing. You don't want to fight the Fed. They are raising rates. They plan to raise them again in December when they meet. Okay, so where are we going? What we want to be looking for in 2023 is inflation slowing. That means prices start to come down and the Fed can begin to relax and provide lower interest rate increases. And we're actually already starting to see that now. Prices are starting to come down. If you go to the stores, I've noticed it. What I want to talk to you about now is make sure that your strategy for investing is appropriate for a recession. Because I always want to give you what you can do, give you strategies on what you can do to become a better investor. So we can't stop the recession. We can't stop the Fed from raising rates, but we can develop a strategy. So what I want to talk about now is a couple of things. Number one, in midterm election years, you'll see the chart right here on the right. Historically, the stock market has not performed well during the year of midterm elections, which this one was. Obviously, we just had an election. But the 3 months, the 6 months, and the 9 months after the election is decided, the stock market has gone up quite nicely. So keep that in mind. The other thing I want to show you is, I'm going to go ahead and share my screen here, is another document here, right here. You'll see okay, let me share that right here. Sorry about technical difficulties. Okay. Historically, when the stock market has drawn down at least 25% or more in the past, what this is showing you here is all the times it has done that in the last, I think, what is this, 80 years. What you're going to see is the percent decline in what year it happened. So you'll see in 1961, the stock market declined 28%. In 1968, it declined again 36%. In 73, look at that, again, 48%. In 1980, 27%. 1987, 34%. These were all very painful times to be an investor. In the year 2000, some of you might remember, the stock market went down 49%. In the Great Recession, 2007 through 2009, the stock market went down 57%. But what you'll see, if you move your eyes to the right, you'll see just 1 year later, 3 years later, 5 years, and 10 years, how much the stock market has gone up after the stock market has gone down so much. So, for example, those of you that are listening and not watching, if you look at 1961, the decline was 28%, but just 1 year later, it was up 30%. And in 3 years, it averaged 16% growth per year. Pretty exceptional. For example, 1973, where we had historic inflation, the last time we had inflation like we have now, and they hiked rates, the stock market declined 48%. But 1 year later, it was only down 4%, and the next 3 years, it averaged a 3% return. Not stellar, but it's just giving you maybe some light in your tunnel. In 1980, which is similar to what we're dealing with now as far as inflation, the stock market would decline 27%. But 1 year later, once investors figured things out, the stock market was up 53%. So what I'm trying to do is give you some hope that all is not bleak. There is it happens. The stock market just begins to turn around, and before you know it, we are back with some great returns. So what I want to show you now is I want to teach you a little bit about recessions, because these are things that we don't teach in school, but we should, because this is a natural cycle, natural stage of the cycle that the economy deals with. What you'll see is there are 4 stages to the economic cycle. There's early, there's mid, there's late, and then there's the recession. Now, early on, the economy starts to move forward. More people are working more hours. Then you move to the mid-cycle, where performance and profit margins peak. And then we move into the late cycle, which is where we were in 2021 end 2022, probably 2021. And I believe now, many people believe we are already in a recession. So if we're already in a recession, which is economic activity declines, credit contracts because they are raising interest rates, that's the goal, raise interest rates, credit is less accessible, and then we see unemployment rising. And what you'll see is all of the major economies here, the bigger the circle, the bigger the economy, are in late stage or in a recession already. So what you'll see is the biggest economy is still the United States, and that is late stage, probably a recession. China is ahead of us and already in a recession, has been for a few months. And then you'll see Japan, Germany, India, etc. Okay, so if we think we already are in a recession, let's take a bite out of that. So a recession sounds very scary. And for those people during a recession that lose their job, might fall behind financially, maybe lose a business, it is a hard time. And for those people, I feel badly for. But this chart, what this chart is going to show you is the expansion cycle during the growth years compared to the recessionary cycle when a recession occurs. So what you look at, I call this the sharp tooth slide, because what it shows is the growth of the economy, that's in the green and blue, the growth of the economy over the number of years it grew, so the expansion of GDP, versus in red, the amount of deceleration in the economy during a recession. So, for example, in the 80s, there was a recession, and you'll see that in red. And then we got some growth, and then we went into another recession. And then from about 1983 all the way till 1980, you'll see massive growth in the economy. So the average number of months that the economy expands is 69 months. And a recession, on average, lasts around 10 months. Now, the reason I give you that information is some might argue we're already in a recession, and we could be coming out fairly soon if we've already been in a recession 6, 7, or 8 months. Of course, we don't always know when we're in a recession until we're out of a recession, because it's a very complicated equation. So you'll see GDP growth decelerates 2.5% during a recession, and it grows 24.6% during expansion that follows. During expansion, we see a net add of 12 million jobs on average. Unfortunately, during a recession, we shed, as an economy, just under 4 million jobs. And you'll see we're already getting those layoffs occurring right now. Now, what this chart is showing you is two different indicators here. The first is the S&P, stock market in dark blue. And then you'll see it transposed on the industrial production, or the economic output. Now, in blue, again, that's the stock market, you'll see it peaks around 8 months before the economy bottoms out. And that's interesting to know, because it peaked in November of last year. So we're now a year into this market unraveling. And then you'll see down the road, because the market is always forward thinking. So it knows that we're running into a recession before we do. That's the intelligence of the market. If the federal government would just leave it alone, things would get sorted out. Now, the economic cycle peaks right here, and then it begins to spiral down. And it takes, on average, around 10 months for it to bottom, and then it starts to find its way up. During that time, businesses slow down, jobs are lost, some people go into debt, businesses close. But you'll see way before that, around 6 or 7 months before that, the stock market starts to go up. Now, some would say, why would the stock market go up if we're continuing to move into a recession? Because the stock market is always forward looking. So it looks ahead and says, okay, we've digested where we're going. Now, where are we going, where we are, and then where are we going from here forward? So it starts to invest 6 or 7 months out, and it has always done that since the beginning of our economy. Okay, what economic indicators can warn of a recession? Now, I bring these up because these are 5 indicators that you probably hear about in the news, and you might not understand what they are or why they're important. Now, the first one here is the inverted yield curve. You probably hear about this. The second is unemployment, consumer confidence. Number 4 is housing starts. And the last is leading economic index, the LEI. Now, inverted yield curve, we're already getting that. So all of these indicators have flashed red. So we could all agree we are already in a recession now. Unemployment is rising. Layoffs are happening a lot in tech and across the board, starting to filter through the economy. Consumer confidence has dropped as people look at high gas prices, high food prices, and then wages haven't kept up. Housing has fallen off a cliff, and housing starts, housing sales, and the the LEI has fallen as well. So all of these are flashing recession, 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 although the government has not said it's a recession yet. Okay, let's keep moving. Now, the key thing for you is, great, Eric, this is all informative, but what do I do about it? Well, let's talk about how to invest during a recession. Now, what you want to be focused on is the different sectors of the economy. What they're listed here is consumer staples, utilities, healthcare, all the way down. What you want to be focused on is sectors with companies that are making money now, because those companies will be rewarded during this recession, because investors want to buy companies that are making money now and paying those earnings in nice, juicy dividends. So what it's showing you here is which sectors perform the best during past recessions. And what it's showing you here is consumer staples. Those companies have done the best during a recession because that's where people spend their money. They might not buy high-end, expensive, lavish goods, but they will spend on things like paper towels, your food, your disposable items in your house, etc. And those companies typically have dividend yields on average of 2.5% a year. And what that means is they'll pay income to all holders of that stock 2.5% a year. So that income is collected and paid out to you. Now, investors love that income, so that's why they buy these stocks. Utilities, that's another great segment, because utilities perform well. People don't shut off their utilities in recession because you need your electricity and you need your heat, etc. And utility companies also pay attractive dividend yields on their stocks, and that's around 3%. And then you'll see healthcare is another good segment. Telecom services, that's another really good segment. They pay nice fat dividends on their stock. And the last one is energy. So that's how you want to be positioned from an equity standpoint. Keep in mind that you still want to hold some growth equity, some growth companies, but understand those probably will be punished during a recession because they don't have the profits that the dividend yielders hold. But keep in mind that we never know when those growth companies will start to become in favor and get bid up and stock prices start to move up. So you still want to hold them, but you want to start buying the dividend. Now, you also want to own bonds. Now, keep in mind, bonds have gotten punished in the last year. The worst bond market in the history of our country, the worst bond market ever. That's not my opinion, it is a fact. But you still want to own bonds because they typically, almost always, have been protection against equities getting sold off. And if you look at all of the past sell-offs in the future, which is showing you right here, bonds have held up really well. And we feel that bonds look promising in the near future. So you want to make sure that you're buying bonds and you're buying the right bonds, and those are high quality bonds, not your high risk bonds, but your high quality bonds. And those are from issuers that are strong, financially strong companies. Okay. Now, hopefully that was helpful. So here's a little checklist of how you should prepare for a recession. Now, the first thing is stay calm and keep a long-term perspective. I'm going to be sending out a really important piece in my newsletter next week about just giving you some perspective on past recessions and the depression that happened in the 30s and 40s. Maintain a balanced and broadly diversified portfolio. It matters the quality of the stocks and bonds you buy and you hold. It does matter. So make sure you're investing in the right companies. Consider balancing equity portfolios with a mix of dividend-paying companies. We just covered that, along with your growth stocks. Choose funds with a strong history of weathering market declines. And this is where I believe we want to look at active management that allows the management team to actively pick the winners for a recession, not just letting an index pick them for you. Use high quality bonds to offset the equity volatility. Remember, bonds, for the most part, have been a place for protection when the equity part of your portfolio is very volatile, and bonds have provided that protection. And of course, speak with your financial advisor. You guys know you can reach out to me anytime and set up a one-on-one consult or a phone meeting. Okay, so where does that leave us? Let's get back to our PowerPoint slide here. So with the midterm elections over, we feel that things are going to look better for the stock market. Of course, we still have to deal with the recession. Okay. Now, so what action can you take? These are 5 things that I can offer you. You can go ahead and get free money tips. Join my email list, and I send out every 2 weeks. I send out an email with tips about personal finance and money. Very simple. To get that free email is text Eric to that number, 22828. You can go on LinkedIn, get some great content there. You can go on my blog, go to retirementpartnersofcalifornia.com. You can book a free consultation if you're if an employee of one of my clients, or if you're one of my personal clients. You get a free consultation with me. And you can also set up or schedule a financial plan for you and your family. So those are 5 ways you can get connected and take action for your financial future. Now, some people on the line might not know what a financial plan looks like. Maybe they've never had one prepared for them. So these are the areas that a financial plan can help you in. Things like an investment snapshot. It can be a net worth snapshot, a retirement snapshot. What that does is it tells you how likely you are to reach your goals based on the current situation in your financial life. It also tells you your net worth. It calculates this every time you log in. So it gives people the peace of mind to know, hey, are we on track for our financial goals or are we not? Also included in here, things like estate planning. Should you get a will or a trust? How to manage your debt and get out of debt at some point, getting a debt plan in place. It'll store your most important financial documents. Having a plan to provide education for a child or a loved one. Do you have the right type of life insurance, long-term care? Do you have a plan to protect your assets in the future? Tax mitigation strategies, all of these are part of a solid financial plan. And I want to be here to help you. So reach out when you're ready. And that's it. I do have time for 1 or 2 questions. If you have any questions, you can put them in the chat. There's no pressure if you don't have any questions. Oh, I do have a question. Can you share the PDF with us? I'm actually going, thank you for the reminder. I'm actually going to share the recording. I'm going to submit this for approval and share the recording and send this out as well. I think the PDF is approved as well. If so, I will send that out to everybody that attended today. So the answer is yes, I think so. Understand that it's very difficult in my space we can't just send things out whenever we feel like it. We have to get those approved. But I am here to help you, so I will get that sent in and I will get that sent out. Okay, thank you everybody for attending today. As you know, I'm here for you. I know recessions are not easy. I'm an investor as well. It's been painful, but I know that we will see it through. Hang in there. If I can help you in any way, please let me know. Have a blessed afternoon. And if I don't speak to you, have a wonderful Thanksgiving. It's a great time for us to be thankful for we all have so much. Have a blessed afternoon. Thank you, everybody. Bye.